What if I told you that most American millionaires didn't get rich from crypto, day trading, or some secret stock formula? They built their wealth quietly through real estate. And here's the crazy part. Many of them started with average salaries, average credit, and average knowledge. The difference wasn't luck, it was strategy. In the United States, real estate is one of the most powerful wealth-building machines ever created. It allows you to use leverage, meaning you can control a $400,000 asset with a fraction of that amount. It allows you to earn monthly cash flow while someone else pays down your mortgage. It gives you tax advantages that business owners and high-income earners legally use to reduce what they owe. And over time it protects you from inflation while your property value and rent continue to rise. But here's the problem. Most people either jump in blindly and lose money, or they stay scared and never start at all. They hear about market crashes, bad tenants, high interest rates, and they freeze. Meanwhile, smart investors are buying strategically, using the system the way it was designed to be used. So in this video, I'm going to break down the most powerful real estate investment strategies in the US, from beginner-friendly approaches that require low capital, to advanced methods used by serious investors to scale portfolios to millions. We'll talk about long-term rentals, house hacking, flipping, short-term rentals, tax strategies, REITs, and how investors use leverage to multiply wealth over time. I'll explain who each strategy is best for, the risks you need to watch out for, and how to decide which path fits your income, time, and risk tolerance. Whether you're starting from zero or looking to expand your portfolio, by the end of this video, you'll have a clear roadmap instead of confusion. Real estate isn't about getting rich overnight. It's about building predictable, long-term wealth using one of the most stable asset classes in American history. And the best part, you don't need to quit your job, you don't need to be a construction expert, and you definitely don't need to be born rich. You just need the right strategy and the discipline to execute it. So, if you're serious about building financial freedom through real estate in the United States, stay with me. Because the strategy you choose today could completely change your financial future over the next 10 to 20 years. When it comes to real estate investing in the United States, the most proven and time-tested strategy is buy and hold rental properties. This is the foundation of long-term wealth building. The concept is simple. You purchase a property, rent it out to tenants and hold it for years, sometimes decades. But the power of this strategy comes from the multiple ways you make money at the same time. First, you generate monthly cash flow if the rent exceeds your expenses. Second, your tenant is paying down your mortgage every single month, building equity for you. Third, the property appreciates over time, meaning its market value increases. And fourth, you benefit from tax advantages such as depreciation, which allows you to offset income legally under guidelines set by the Internal Revenue Service. One unique advantage in the US market is the availability of 30-year fixed-rate mortgages, which lock in your payment while rents continue to rise with inflation. That spread over time can significantly increase your profit margins. However, this strategy isn't completely passive. You must manage tenants, handle maintenance, and prepare for unexpected repairs. Smart investors account for vacancy rates and maintenance reserves before buying. Buy and hold works best for people who want steady, predictable wealth growth rather than quick profits. It rewards patience. Over a 10 to 20-year horizon, the combination of appreciation, loan paydown, and rental increases can create life-changing financial stability. This is not flashy investing, but it is powerful, scalable, and historically reliable in the American market. House hacking is one of the smartest entry points into real estate, especially for beginners who don't have massive capital. The idea is simple. You buy a property, live in one portion of it, and rent out the rest to cover your mortgage. This could mean purchasing a duplex and renting out the second unit, buying a triplex or fourplex, or even renting out individual rooms in a single-family home. What makes this strategy so powerful in the US is access to low down payment loan programs, including those backed by the Federal Housing Administration. With as little as 3.5% down, you can control a multi-unit property while living inside it. In many cases, tenants pay most or even all your housing expenses. That means you're building equity while reducing your personal living costs. Essentially, you're turning your biggest expense housing into an asset. This strategy is especially effective for young professionals, first-time buyers, or anyone willing to sacrifice short-term comfort for long-term gain. Of course, there are trade-offs. You're living close to your tenants, which may require clear boundaries and strong communication. But financially, the advantages are massive. After living in the property for the required time period, you can move out, convert the entire property into a rental, and repeat the process. Over time, this creates a snowball effect. House hacking allows you to enter real estate with lower risk, lower capital, and immediate practical experience. It's one of the fastest ways to transition from renter to investor in America. The fix and flip strategy is one of the most popular real estate investment methods because it offers the potential for fast profits. The concept involves purchasing undervalued or distressed properties, renovating them to increase their value, and reselling them at a higher price. Unlike buy and hold investing, flipping focuses on short-term gains rather than long-term cash flow. The key to success in flipping is buying below market value. Experienced investors know that profit is made at the time of purchase, not at the time of sale. You must accurately estimate renovation costs, holding costs, closing fees, and market conditions before making an offer. In a strong market, well-executed flips can generate significant returns in just a few months. However, this strategy carries higher risk. Renovation costs can spiral if inspections reveal hidden issues. Market shifts can reduce resale values. Interest rates and holding timelines matter greatly. Flipping requires active involvement, strong contractor relationships, and disciplined budgeting. It is not passive. Successful flippers analyze neighborhoods carefully, focusing on demand, comparable sales, and buyer trends. They also maintain contingency funds to protect against unexpected expenses. While flipping can accelerate capital growth, it is generally better suited for investors who have experience, liquidity, and tolerance for short-term volatility. For those willing to put in the work and manage the risks, fix and flip can be a powerful wealth-building accelerator within the U.S. housing market. Short-term rentals have exploded in popularity thanks to platforms like Airbnb, which allow property owners to rent homes nightly or weekly instead of signing long-term leases. This strategy can generate significantly higher income compared to traditional rentals, especially in tourist-heavy cities, business hubs, or vacation destinations. The appeal lies in flexibility and premium pricing. Instead of collecting $2,000 per month in long-term rent, an investor might generate that amount in just a few weeks during peak season. However, higher returns come with higher involvement. Short-term rentals require active management, marketing, guest communication, cleaning coordination, and property staging. Regulations also vary by city and state. Some municipalities restrict or heavily regulate short-term rental operations. Before investing, it's crucial to verify local laws, licensing requirements, and homeowners association rules. Additionally, income can be seasonal. Tourist markets may fluctuate depending on economic conditions and travel demand. Successful short-term rental investors focus heavily on property presentation, customer reviews, and occupancy optimization. They treat their properties like hospitality businesses rather than passive rentals. While the income potential is attractive, this strategy requires more effort and operational discipline. For investors who enjoy hands-on management and are comfortable adapting to market conditions, short-term rentals can outperform traditional leases, but careful research and compliance are absolutely essential. One of the biggest advantages of investing in U.S. real estate is the powerful tax benefits available to property owners. Many beginners focus only on rental income and appreciation, but experienced investors understand that tax strategy can dramatically increase overall returns. Through depreciation, investors can deduct a portion of a property's value each year as a non-cash expense, reducing taxable income. This benefit is governed by rules established by the Internal Revenue Service. Even if your property generates positive cash flow, depreciation may allow you to report little or no taxable profit. Another powerful tool is the 1031 exchange, which allows investors to defer capital gains taxes when selling one investment property and reinvesting the proceeds into another qualifying property. This enables portfolio growth without immediate tax penalties. Over time, investors can scale significantly while legally deferring taxes. Additionally, expenses such as mortgage interest, property management fees, insurance, and maintenance are typically deductible. These combined benefits make real estate one of the most tax-advantaged asset classes in America. However, tax rules are complex and should always be discussed with a qualified professional. When structured properly, tax efficiency can turn a good investment into a great one. Understanding these advantages separates casual landlords from strategic real estate investors. For those who want exposure to real estate without managing properties directly, Real estate investment trusts, or REITs, offer a passive alternative. REITs are companies that own, operate, or finance income-producing real estate across sectors such as apartments, shopping centers, offices, and industrial properties. Investors can purchase shares of publicly traded REITs through the stock market, just like buying stocks. This provides diversification and liquidity without the responsibilities of property ownership. Many REITs are listed on exchanges like the New York Stock Exchange, making them accessible to everyday investors. One major benefit of REITs is dividend income. By law, most REITs must distribute a large percentage of their taxable income to shareholders. This makes them attractive for income-focused investors. However, REITs do not offer the same control or leverage opportunities as direct property ownership. Market volatility can also impact share prices in the short term. REITs are ideal for individuals who want real estate exposure within retirement accounts, or for those who lack the time and capital required for physical properties. They provide diversification and convenience, though potentially lower long-term upside compared to leveraged real estate investing. The final strategy that separates average investors from wealthy portfolio builders is scaling through leverage and equity recycling. In the US system, once a property appreciates and the mortgage balance decreases, investors can access that built-up equity through refinancing or home equity lines of credit. That capital can then be used as a down payment on additional properties. This creates a compounding effect. One property becomes two, to become four. And over time, a portfolio begins to expand rapidly. The key is disciplined leverage. Borrowing amplifies returns, but it also amplifies risk. Investors must ensure cash flow remains strong and reserves are maintained to handle vacancies or downturns. Strategic scaling focuses on stable markets, conservative underwriting, and long-term planning. Many successful investors build wealth not by selling properties, but by holding them and continuously leveraging equity to acquire more assets. This snowball approach allows inflation, appreciation, and rental growth to work simultaneously across multiple properties. However, over-leveraging can be dangerous during economic downturns. The goal is sustainable growth, not reckless expansion. When executed carefully, leveraging equity is one of the most powerful wealth-building mechanisms available in the American real estate system. So, here's the truth about real estate investing in the United States. There isn't one perfect strategy. There's only the strategy that fits your income, your risk tolerance, your time availability, and your long-term vision. Some of you will thrive with steady buy and hold rentals. Some will accelerate capital through flipping. Others will start with house hacking to eliminate your biggest expense. And some of you may prefer the simplicity of REITs while you build confidence. The key isn't choosing the flashiest strategy. It's choosing one and committing to mastering it. Real estate rewards patience more than hype. It rewards discipline more than emotion. The investors who win aren't the ones trying to time the market perfectly. They are the ones who understand leverage, manage risk wisely, and think in decades instead of months. Remember, property values fluctuate in the short term, but over long periods, US real estate has consistently built generational wealth for those who stay in the game. And here's something powerful to think about. 10 years from now, you won't regret the properties you analyzed carefully and bought strategically. You'll regret the opportunities you hesitated on because of fear or overthinking. Every successful investor once stood exactly where you are right now, uncertain, cautious, wondering if it was the right time. The difference, they took calculated action. You don't need to own 50 properties. You just need to start with one smart move. Learn the numbers. Study your local market. Build your reserves. Surround yourself with the right information. Wealth in real estate isn't built overnight. It's built property by property, decision by decision. If you found value in this breakdown, hit the like button, subscribe for more deep dives into US investing strategies, and comment below which real estate strategy are you planning to start with. Your journey to financial freedom might begin with that one decision.